three things retirees regret they didn't do earlier in life. The first one is a big one. It's taxes. The way we're kind of taught right now to plan for taxes is we're going to save as much as we can on taxes this year. You talk to your accountant, they're going to give you a look back. They're going to pat themselves on the back. Hey, I just increased your refund by $1,000, let's say, right? You're pumped about your accountant, well worth the money. Problem is we need to actually project out in the future taxes today versus taxes later and really have a good balance between the two. Because what we're taught is basically, all right, stuff your pre-tax accounts now, and then you'll be in a lower tax bracket later. But I found actually having a mix of taxable accounts can really make a difference. I'm going to do a quick recap. There's a whole video I have about tax buckets and how investments are taxed. I encourage you to check that out for more detail. But quickly, here it is. So what we're really taught is, okay, let's use this pre-tax bucket, right? That's going to be your traditional 401k, traditional IRA, but basically money goes in pre-tax, grows tax deferred. You take the money out, that's when you pay taxes. The opposite of that is, a Roth bucket, basically. So you put money in after tax, grows tax-free, take the money out. Hey, it's tax-free. Awesome. Third bucket is the after-tax account. So money goes in after taxes, grows, tax on it, not so fun. You take money out, there's gains, you're taxed again. So not as tax efficient, but more flexible. What we found is many people are here, right? And they put most of their money there. They don't really think about providing balance. Because what's going to happen is life is not linear. So when you're in retirement, you're going to want to redo your kitchen. You're going to need to redo your roof. You're going to need a new car. And you're going to have these spike expenses that come up. And what happens is when you only have one bucket of money, you're going to withdraw from that, pay all taxes, and then you have some ripple effects. Your tax bracket could go up. And two, your IRMA tax bracket could go up, which means your Medicare premiums can be more costly as well. So it has all these ripple effects that we want to make sure we're managing. One way to manage that and have a lot more control is mixing in Roth and after-tax money. But we have to do it strategically. So you want to think about, okay, what's the right mix to have now versus later? Generally, younger people want to lean more into the Roths. More seasoned people, more established people, the higher income earning years want to lean more into the pre-tax bucket here. Either way, you really want to try and have a mix, because one thing you really can't do, especially as a W-2 employee, is really manipulate your tax bracket. In retirement, though, when you get to choose which source of money you're coming from, one of the three, you can say, hey, this year I'm leaning to the Roth and take a little bit out of pre-tax. You can really design your tax bracket with intention. That's a big regret I see in many retirees.